I'm going to show you how a rate cut can slice $41,000 off your mortgage. There's been one rate cut so far, there's more predicted, and they're creating huge opportunities for homeowners to save big on your mortgage. You could save tens of thousands of dollars and cut years off your mortgage.
Show me what you got.
Sounds pretty great, right? In this video, I'm going to show you exactly how to take advantage of these rate cuts. I'm going to break it down step by step, so keep watching. All right, so let's dig deep into the recent rate cuts and potentially how there's more rates to come and how they're going to impact your mortgage. The Reserve Bank of Australia has cut the official cash rate by 0.25% so far, and a lot of lenders have passed that on to most people's variable rate interest rates. Now, while 0.25% doesn't sound like much, even small changes can make a huge difference to your home loan, especially if you take the right approach. Let me show you an example. Let's say your original loan was $642,000 at 6.33% over 30 years. Your monthly repayments were $3,988 for the rate cut. After a 0.25% rate cut, your new rate is 6.08%. The new monthly repayments are $3,892, and you're saving about $96 a month in your payments. Per year, that works out to be $1,152. But if there's more rate cuts later in the year, a lot of the banks are predicting up to 4 rate cuts in 2025, a total of 1%. Your new interest rate would be 5.33. Your new monthly repayment is $3,579. Your monthly savings is $409, and your yearly savings is just under $5,000. Now, as great as it is having another $400 a month in your pocket, even better is potentially paying off that loan years faster. Instead of lowering your payments each rate cut, you can consider maintaining them at the original or current $3,988. If you kept your payments at the pre-rate cut amount, after one rate cut of 0.25%, you potentially save $41,000 in interest over the life of the loan and pay off your loan 2 years and 4 months faster. After 4 rate cuts of 0.25%, so a whole percent rate cut, you potentially save $150,000 and shave 7 years off your loan by just keeping the repayments the same as they were. So even a modest rate cut can add up. Some banks will not automatically lower your payment, so this may happen automatically without you realizing it, and if you're comfortable with your cash flow and your budget, you can just leave it. Other banks like Macquarie and Westpac will automatically lower your payment to the new minimum amount. So potentially you need to ask them and say, hey, no, I want to put it back up to where it was. I want to pay extra and get rid of this sucker as quick as I can. All right, so that's a super quick intro on how rate cuts can save you money. But what happens if your bank isn't playing ball? Well, there's some banks like Bank of Queensland Specialist and Virgin Money that didn't pass on the full rate cut. And that's where refinancing may come into the fold. Think of refinancing kind of like upgrading your mobile phone plan. When you first signed up for your mortgage, it may have been the best deal, but now a couple of years later, it may not be as good a deal. Different banks can be competitive at different times in the market, and refinancing could give your home loan a bit of a refresh, a bit of a spring clean, and help you pay off that thing quicker. You might want to consider refinancing if your bank didn't pass on the full rate cut. If your bank's rate isn't that competitive, you might have had your property value increase and the bank's still thinking like you've got a 10% deposit. Or if that differential, if your current rate say 6% and there's banks offering 5.5%, it could make sense to refinance even though there are some costs. Which comes to some of the drawbacks of refinancing. There are fees. Generally, it costs about $1,000 to $1,200 to switch lenders, just because there's usually like a discharge fee, a processing fee with your current bank. There may be new setup fees with the new bank. There's registration of mortgage fees, there's discharge of mortgage fees, they're just government fees that you pay, and some small changeover costs. So it's not completely free. And if you're changing for like a 0.01% difference, it probably won't be worth it because you're not going to be able to recoup those costs of switching. But like I mentioned before, if you're changing for say 0.5% difference, it can make a world of difference. There's a really awesome calculator on ASIC, I'll include in the link below. It can give you a sense of how long it'll take to recoup the cost of switching, just to make sure it is definitely financially beneficial to move banks and you're not just chasing a lower rate for no real financial benefit once you pay the fees and everything else. All right, so the way to use this mortgage calculator is put in your current loan balance. So we'll say the example before, let's say your current interest rate is 6.33, the term remaining is 25 years. Say if, like I said, it costs about $1,200, you need to put in all your regular fees. So you might have like a $395 annual fee. Say there's a new bank that's offered you a rate of 6.1%. And the regular fees are the same annually or yearly. So if you're reducing your rate by say 0.23%, is it worth it? Yeah, potentially. It's going to take 15 months to recoup those costs of switching, but over the life of the loan, you might pay off the loan 18 months quicker. The only risk when you're sort of moving that close is if there are future rate drops in the next couple of months and they do something like say Virgin or Bank of Queensland Specialist did, you might end up having to switch again and you may not recoup your costs. So that's where it might be a bit marginal. And if the rate's closer, 6.22, it's only 0.1%. If it's going to take you 3 years to recoup the cost and you think you might end up selling the place or doing something in the next 2 years, then it may not make sense to refinance. So have a chat to your broker, run through this calculator. But I really like this one as just a quick way to be like, oh, it's a bit of a sanity check to see if it makes sense to switch. So the calculator is really powerful. It's going to show you how much money you're going to save each month by making the minimum repayment. So that's if you get a rate drop, the new rate is lower, the new repayments are lower, how much you're going to save in that case. But I think the more powerful one is if you make higher payments. So if you keep making your payments, say based on 6.33%, and you get a lower interest rate, then potentially going to pay off the loan, 11 months faster. So it's pretty amazing, really good calculator, and super easy to use, like you can see. Your mortgage broker can help you filling out this calculator and see what's available in the market. Like I mentioned before, one big thing that changes a lot is if you bought your home, say 2-3 years ago, you had a 5% deposit, you might have used the home guarantee scheme. Your property may have gone up in value. So now your loan, instead of being at 95% of the home value, your home value might have increased. It might be at 70% of the home value. There's going to be different deals in the market, and your bank doesn't always recognize that increase in value.
Can't see anything.
So have a chat to your broker and see what's available in the market there. Which brings my next section. How do you compare other mortgage offers? So if you've tried to hit up your bank and say, hey bank, I'm going to leave, what else is in there in the market? It could be worth looking at refinancing. This is where it pays to do homework or speak with the mortgage broker to see what's possible. Why would you use a mortgage broker? Well, the benefit is we do all the legwork for you. We research different lenders, see what's possible, even look at different features that might be important for you. You might have a bank that has an offset account. You might really like how that's set up just for your budgeting purposes. It's easy to kind for your cash flow. You might have different accounts for your future savings. If you go to some of the online lenders, they may only have redraws. You might have to change how your cash flow works. You have to move your direct debits and everything else like that. So consider that. And even the internet banking facilities. I've had people go to smaller non-bank lenders. They might go to like First Mac or something like that, who basically have no internet banking facilities, pretty minimal offset account. You don't have like the Visa debits and that sort of thing. So just need to be careful of that and look at all those features and just look not just at the rate, because it's obviously important to save money. But if you can't take advantage of your offset account, you might have $50,000 or $100,000 sitting there, then it could cost you more in the long run. The other benefit is with the brokers, we can obviously save you time from running around. We can negotiate with the lenders. So generally, if we know there's a special deal with Westpac and you really want to go with CommBank or something, we can say to CBA, hey, try and match this, we're going to go somewhere else. So it helps you shop around with that. Everyone's situation is going to be different. You might be looking at doing renovations, and this is where different bank valuations may play into things. I've seen some banks value the same property, the same home in the same week by up to $150,000 to $200,000 different. So that can make a difference with your rates and how much equity you might have. You might be considering a car loan, heaps of different things. So if you are looking to review your home loan, if you're looking for any help with all the rate cuts and trying to understand what happens and how you can make the biggest benefit of it, hit us up at Hunter Galloway, with a home for homeowners across Australia. If you need help with refinancing, you just want to get a bit of a sanity check on your current home loan and see if it makes sense to switch or anything else, hit us up. We'd love to help you out at huntergalloway.com.au. The bottom line is we're currently in a rate cutting cycle. This means there's potentially an opportunity for you, whether it's locking in lower rates, refinancing to get away from your current bank if you don't like their platform or their situation, or just saving on your monthly repayments. Now's the time to act. Don't keep pushing it back, especially if there's a huge difference in your current rate to what's available in the market. Just hit us up. A 5-minute phone call can save you years off your mortgage. I definitely suggest reviewing your current cash flow. If you think you can keep your payments on that high one, like I said, it can save you $41,000, depending on your loan amount, depending on your rate difference, without having to change anything potentially. Just leave the payments how they were. It's the easiest $41,000 you'll ever save. If your bank's not moving around, you need to really consider refinancing, especially if it's getting over that sort of 0.25% rate differential, even with the costs. And while there are some banks doing cashbacks, there's not a lot. So use a broker to help shop around and see what's possible there. And try and stay proactive. At Hunter Galloway, we help our clients. We do a review every 12 months, sometimes more frequently. So if your broker's not doing that, give us a call. We'd love to help out. huntergalloway.com.au. And until next time, I'll see you later.